Hey, what's up, everyone? It's Josh Flores from Wall Street Saturday. I just want to thank you guys for checking out the video this week. If you can, please support the channel by liking the video and subscribing. And I just want to inform everybody that everyone on this video are not financial advisors, nor anyone's financial advisors. Anything that's said or seen on the show is strictly for educational purposes only. With that being said, please enjoy the show. Hey, what's up, everybody? You got Josh Flores here.
Misael Gonzalez.
And Joshua Trusty.
Yeah, and before we get started here today, we're going to start us off with a prayer, as we always do here on Wall Street Saturday. And so let's go ahead and start with that. Dear Heavenly Father, we just thank you for another week, another time to get together in a fellowship with my brothers here, and for any viewers out there listening as well. And we just want to thank you again for the opportunity to just be here and talk about the things that you have worked through in our country and our world this week, and just help us have eyes to see what you're doing and a heart of understanding, and just help us capitalize on anything that you want us to understand or be a part of, and just pray for the safety of our world as things go on around the world, particularly in Russia and Ukraine over there, and just with the inflation and jobs that are going here in this country. And again, Lord, just thank you for being our God and taking care of us. And it's in your holy name we pray. Amen.
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 So for today on the agenda, one of the things we want to discuss is actually the leisure and hospitality sector. So without any further ado, I'm just going to start presenting a very quick study on this topic. Okay, so here's a bit of the background for this discussion. We've been talking about this in prehistoric Wall Street Saturday times, and I just wanted to catch everyone up on what the status is of this discussion, and as well as provide some context for why investing in the leisure and hospitality sector might be of interest to you. So one of the things that we discuss quite often on the show is that either time in the market beats timing the market, or perhaps even better stated as stay long, stay green. And so one of the ways you can stay long is by having a long-term strategy for your portfolio. And so these long-term strategies end up being very profitable. But if you want to make the most money, you have to figure out exactly where you should be putting your money. And so a good way to do this is to find some sort of sector, industry, ETF, or a company that's in an area where there's going to be a lot of economic activity. So you want to be where the money is moving towards, not where it's moving away. And if you want to figure out where the money is moving, you can actually go to the US Bureau of Labor Statistics. So the US BLS actually will produce monthly long-term outlook reports on the overall economy in the US. And so if you look at the chart on the right, you can see a couple of sectors that we've talked about before in the past on the show, one of them being information technology. So the US BLS actually reports a long-term outlook from, say, 2020 through 2030, and you can see what the top sectors are that are going to be growing the most by cumulative average growth rates. So that's essentially how much that particular sector is going to grow each year. So if, for example, a CAGR is about, say, 4%, that means that every single year from 2020 through 2030, it's going to grow by 4%, and that actually compounds, which is very nice. And so, while I mentioned before that information technology is one of our favorite sectors, and it's also poised to be a top sector of growth, it actually isn't the biggest sector of growth through 2030. That title would actually go to leisure and hospitality over here with a CAGR of about 4.5%. And the reason for this is actually summarized in a quote in the below section, where it says, unlike the past two projection periods, the leisure and hospitality sector is projected to see the fastest output growth among service providing sectors in 2020 through 2030, with its output increasing at an annual rate of 4.5%. And then a key part of this is that this growth is largely recovery driven. So it's obviously very clear that the US still believes in the recovery narrative, and the recovery of the leisure and hospitality sector, which was languishing and actually quite in danger during the COVID-19 pandemic, is well on its way towards recovering and being stronger than ever before. Now, obviously, there's still a question of how long this recovery will take for leisure and hospitality, but that's one thing to continue thinking about as time goes on. So, if we take a look at different industries that are within these various spaces, we can actually figure out where we might want to invest in terms of being even more specific than at the sector level. So, for example, this is a donut chart, which I love donut charts because what they do is all of like the major categories, the larger categories are towards the center. So you have leisure and hospitality, information technology, educational services, manufacturing, and then the way that you have like the subcategories, or in this case, industries, on the outer parts of the donut chart. So, for example, amusement parks and arcades, they are also part of leisure and hospitality, but that's a specific industry. And so, one thing to consider is that it's possible to invest in a sector-wide ETF and actually win. So, for example, leisure and hospitality has significant cumulative average growth rate across the board. So let me actually show you what that numbers are behind all these different categories. So the gray is the leisure and hospitality, but for where we saw arcades, that will have a cumulative average growth rate of about 7.1% over the next 8 years, since we're already in 2022. And so you're seeing like a range from say 7.1 to 5.1 to 4.7. And there are, of course, like other areas of significant growth, like outside of leisure and hospitality. So, for example, this orange section here is information technology. And that also tends to have cumulative average growth rates, at least in its top industries, around 5.1, 4.7, 4.2. But obviously, the sectors that are going to, the industries that are going to see the largest amounts of growth are probably going to be in leisure and hospitality. But still, without even investing in an industry ETF, you can still invest in a sector-wide ETF and do quite well. So one thing to consider is what leisure and hospitality sector ETFs exist. And for me, this was actually a really interesting part of the research. So one really broad play, which would be JRNY, or the Alps Global Travel ETF. This one is an opportunity, but in the research that I did, it seems as though a lot of investors have already kind of like processed like the projections, because remember, the US BLS provides information to everybody for free. So of course, a wise investor would be taking this into account. So JRNY's top 10 constituents represent or constitute about half of the assets that they have in their ETF. And so the PEG and the PE ratios of their top 10 constituents are significantly elevated. So for example, this information is from October. And if you look at the industry from price to earnings growth ratio for say BKNG, their PEG ratio, their PEG ratio is well above 35, whereas the industry PEG would be under 5. And so for a lot of these, you see like the blue lines here are actually exceeding what is standard for the industry. So in that case, you can see that a lot of their constituents tend to be very expensive with regard to the growth rates of these different companies. And in addition, at the time, these PE ratios were also sky high, like for example, look at say Disney at the time was above a 250 PE ratio, which is extraordinarily expensive. Typically for Wall Street, you would see something around maybe 15, but this is far in excess of that. I will say, since this data was pulled, the PE ratios and the PEG ratios have come down a little bit, but yeah, they're still quite high. So one other question we can ask in the future is, why are people still investing in these stocks even though they're still expensive? I don't necessarily have an answer in the immediate for that, but that's one thing to consider for future reference. And there's also an alternative to JRNY, and that would be BEDZ, or the Advisor Shares Hotel ETF. This one is really interesting because, like the name suggests, they're more about beds or say hotels. So they tend to fall under the accommodation category, and their PE ratios at the time of when the data was pulled were actually below industry. So you can see that these orange lines, once again, are the PE ratios of the different industries that they're in, even though these industries are all related to leisure and hospitality. So the orange lines tend to exceed the blue lines of these constituents. So for something like BYD, you can see that their PE ratio is about 20 at the time, and the industry PE ratio is about, say, 26 or 27. Only on certain occasions do the PEG ratios sometimes exceed what's present for the industry. So for example, GLPI, that one actually has a PEG ratio that's exceeding its industry. And you'll also notice that there aren't not all of these constituents like have information, and that's because at the time, a lot of like the PEG ratios and PEG ratios weren't available due to sometimes them being negative because the past year, including 2020, was just that bad. So a PEG ratio just wasn't applicable at the time. In fact, it would, if you had calculated it, it would have been negative. It's just true as well for across pretty much a lot of the different companies across the board. So one thing also to consider is that BEDS tends to have, or at least had at the time of October 2021, the best 3-month performance in the consumer discretionary ETFs. Also, one other thing to consider is that this ETF will give you exposure to the gambling industry, if that is an ethical consideration that would play into how you make your portfolio. Okay, so one other thing that I've been thinking about, as I've mentioned a couple of times in the show, is how do we manage our risk in terms of modern portfolio theory? So here is a quick overview of the risk assessment for, say, BEDZ, JRNY, XSPM, JETS, SPY. So SPY is obviously the S&P 500. It's a good ETF to compare in general. And then JETS is also another travel ETF, but they're more for air transportation, like the name suggests, obviously. It's a global JETS ETF. And XSPM is just a small cap value play, which would pair nicely with BEDZ, since BEDZ or BEDS tends to have more of a value focus than, say, something like JRNY. And so at the time, it's a little difficult to get a solid Sharpe ratio to compare all of these different ETFs. However, what I did was I plugged in the top 10 or as many constituents as I possibly could for BEDS into a calculator, and it essentially simulated the effect of having the BEDS portfolio, and that gave a Sharpe ratio of about 1.39. After several more months pass, we'll probably have enough data to actually look at what the real world Sharpe ratio is for, say, something like JRNY and BEDS. But for now, 1.39 is my best estimate for the Sharpe ratio of BEDS, which actually outperforms XSPM, JETS, but not SPY. And I would say, as of now, it still remains to be seen as to which one of these two would be the better bet in terms of for risk assessments, mainly because first, BEDS is kind of a young ETF, whereas SPY is the oldest ETF on the market. So there is that level of uncertainty, but still we do know that over the long term, in the next 8 years, the leisure and hospitality sector should be outperforming the broader market. So even though the immediate history that's available would not necessarily suggest that BEDS would outperform SPY, based on the projections, that is something that that may indeed happen. And finally, here we have an estimated efficient frontier for BEDS. So for those of you that don't know, the efficient frontier is essentially a chart that shows what are the most efficient combinations for risk management in terms of the Sharpe ratio for that particular portfolio. And so on the right, you have a portfolio or a portfolio that is essentially has like the maximum standard deviation, but also would give you the largest performance. Although at the same time, there's more uncertainty. On the left, you wouldn't get that performance, but you would have as minimum standard deviation as possible. So you're not going to make as much, but at least you know even with greater certainty what you're going to get. And so what to me is very encouraging about this efficient frontier in the combinations of different constituents is that it's pretty diverse, like especially towards the middle and towards the beginning as well. So what that suggests is that if you want to be in the middle of the road with a mix between certainty, uncertainty, and tepid performance versus extreme performance, you can still do that while having a variety of different stocks. So in that case, it actually suggests that BEDZ or BEDS is right to include all of these various constituents. So it's not as though there is one particular constituent with that is drastically outperforming the other, and you don't really have need for BEDS. As a matter of fact, it actually does seem that they were right to include all of these. So for me, looking into doing that analysis, that is quite encouraging. Although obviously you can see the data is quite limited for that particular ETF based off of the constituents that I was able to pull. All right, so in conclusion, the LNH or leisure and hospitality sector is one that we should be regular in the way that we're looking at it. So there's a lot of growth that's going to be occurring there, and it's something that we should be paying attention to consistently. So there are some opportunities there that are a little expensive, like JRNY. However, the fact that investors keep on investing in the ETF as well as its constituents does suggest that there is something to it, that perhaps these constituents and the ETF thereby will continue to increase. BED shows promise as well, but it would be nice to get some more information on what its Sharpe ratio actually will be. So we can expect more information on that over the next couple of months. And there may be other or older LNH ETFs that would provide another path forward for easier analysis in terms of getting the Sharpe ratio. So JRNY and BEDS both are kind of young ETFs, and there may be some other ones out there which we can look into in the future, which will have Sharpe ratios that are better defined. So that's a quick overview of the leisure and hospitality sector and why you should consider investing in it, particularly with two of the ETFs that have been analyzed, like BEDZ and JRNY as well. All right, with that said, any thoughts or reactions from the other commentators on the show?
Yeah, so if I'm kind of getting this right, BEDZ is really more of the value side, and then JRNY is more of like a small cap growth, kind of more risky, right? Is that what you're?
Yeah, what I would say is that, let me go back to the charts. That BEDZ, if you look at, or BEDS, if you look at like the PE ratio, it's kind of a deal, a nice deal in terms of where the industry is right now. The industry typically has more expensive PEG ratios or higher PEG ratios or higher PE ratios. Whereas if you look at something like JRNY, they actually tend to have like just very high PE ratios. So there's kind of, those stocks tend to be more expensive. Mm-hmm. Do they actually outperform in terms of JRNY versus BEDS? I don't know just yet, mainly because the Sharpe ratios for those two ETFs haven't come out yet. And so if I were to try to simulate something like JRNY in terms of getting its Sharpe ratio based off of the top 10 constituents, that would only represent about half of their assets under management. So it's a little more challenging to try and simulate and estimate what that Sharpe ratio is for JRNY. Otherwise, I definitely would have included that in there.
So would you actually suggest getting both, just having exposure to both of those?
So I would say for me, I'm looking into getting exposure at least to BEDS. With JRNY, I still need to do a little bit more research to figure out why so many investors are still investing in JRNY. Like why is there such a premium that exists there for something like Disney or BKNG? I believe that's DraftKings. And so I'm not entirely certain as to why that's such a high premium is there, but obviously it seems like some people have done their research, and it seems as though there's something compelling about these stocks and the overall ETF that is leading these people to purchase these constituents. And I'm not sure as to why overall JRNY tends to have these more expensive stocks in their portfolio versus something like BEDS. I think maybe it may be the case just that BEDS or the hotel and gaming industry overall is just less expensive than something like just leisure and hospitality in general. Maybe people are investing in leisure and hospitality more generally speaking, and therefore that's why the overall leisure and hospitality sector tends to be, at least like from the perspective of JRNY anyway, tends to be more expensive than that specific subsector or subsection or industry of BEDS. So maybe it's just that BEDS is the odd one out in terms of all of the different industries that exist in LNH. But like I am someone who likes to get a good deal, so for me, BEDS tends to be the most attractive out of these options. And there may be some other options too, like Jets is also a travel ETF, which would fall under the category of leisure and hospitality, because you actually need to get to these places, right? If you want to have some fun, like say someplace like Disney, you got to fly over there. You're not going to just walk from Houston over to Orlando, right? So to that end, I think there are other ETFs as well within like the leisure and hospitality sector, which might be interesting investments. It's just that I would say for me, I think JRNY is a pretty broad ETF, but there may be more focused ETFs that are in specific industries, like for example, BEDS, which might provide a better alternative and just overall have cheaper constituents.
Oh yeah, I think this is like a really great place to start out with too. I mean, even just getting exposure to both, I think would be good. And then you broke it down on these constituents, and I think it's definitely worth looking into these individual companies as well. Obviously, Disney's like a very well-known company, of course, and that's I guess we could all really be owning that long term, right? I mean, I'm sure in 20 years we're still going to be watching Disney movies, but like EL and CTAS, I'm not entirely sure what those are. Airbnb, I hear that they have very great management. I know that they IPO'd sometime last year, so there's not like a lot of public information to make a super well-informed decision on that. But yeah, I think these are both like pretty cool plays. I mean, I might gain exposure to them both as well. Jets, I guess I would kind of like look into, just because who really knows about the airlines, right? Like,
right.
I mean, those are just high cost services, and so I'm sure that the price of oil and gas is like either helping or hurting them. I could see it going both ways. But I mean, even at this point, I mean, the climate of the country right now is kind of crazy. So I mean, I think both of these are like pretty good prices. I did see that JRNY is only down less than 1% year to date. So that's actually, I consider that pretty good, since the S&P is down almost 7% year to date currently. BEDS was down a little bit more, but I think again that just provides an opportunity to get it at an even cheaper price.
Right.
Yeah, it's only down 5% at $25 year to date. So I mean, and the fact that the U.S. government's kind of thinking that is going to be pretty good, I think that provides some security as well. I know I've been talking a lot, but yeah.
I would also like to add that some of the numbers have improved since I originally created the PowerPoints as well. So for example, a lot of these PE ratios have actually gone down, as a matter of fact, which is a good sign. And the same thing goes for JRNY too. So Disney isn't as overpriced as it used to be. So a lot of these offerings do appear to be more attractive now than when I had originally done the research back in October.
Oh yeah. Yeah, I remember this has been on the waiting list to talk about for a minute.
Yes.
But principals still say we got till 2030, right?
Right. Yeah, and also like this is just part of like doing some longer term research for a longer term investment, right? So I'm not doing this research just so I can make an investment over like the next week or even just start day trading. This is just for so I can actually invest over the next 8 years, which is when the USBLS information is applicable for. And of course, they update this stuff every month too. So if I were to say that just review it every single month, I could make some small changes on like on a month to month basis, like for an 8-year investing period.
No, definitely. Yeah.
So I highly recommend checking out the USBLS website. They have a ton of information on what's going on what experts think about the economy and how it's going to evolve over the next 8 to 10 years. And it's free. So, I mean, and you're paying for it anyway. Well, you're paying for it anyway with your tax dollars. So why not take advantage of the information?
No, I agree.
Any other thoughts on the matter?
Not for me.
All right. So armed with this knowledge, now you know how to stay long. Keep investing so you can stay green. Until next time, everyone.
Hey, what's up, everybody? Thanks for another episode of Wall Street Saturday. You have Josh Flores here.
Joshua Trusty.
Misael Gonzalez.
Yeah, thanks guys for getting on a call. We just wanted to bring up some big important things that have happened this week. I mean, to be honest, it is big and important just because it keeps crashing the market, but it is the same update from the past couple of weeks, and that is inflation and the situation that's going on with Russia and Ukraine. I just want to point out that on the 28th of January is where we started our recovery. And then we kept on recovering until February the 9th, which was Wednesday, where we got new CPI data, which revealed that inflation is now at 7.5%. And then the day right after, which was yesterday, Friday, the 10th, or not the 10th, but the 11th, was when we were starting to really get concerned about the Ukraine and Russia situation there. I had seen some things in there that the US is actually pulling their citizens out of Ukraine. I don't know if you guys had seen. I think Japan is also doing the same.
Yeah, we're starting to see diplomatic action in terms of getting people out of embassies and asking citizens to get out of the country. That's not a good sign. I mean, we saw the same in Afghanistan, that, you know, in the evacuation was imminent. We're not evacuating people from there, but yeah, just this morning, Biden apparently had a call with Putin, just trying to talk things down to prevent a last minute effort to prevent an invasion. So at the moment, Russia has 130,000 troops on the border, and looks like the U.S. is sending around 9,000 troops each week for the past few weeks to neighboring countries just to have them ready. So it looks like it's not a matter of if but when. I predict that it's going to be over this weekend, and some others have predicted that maybe it's midweek next week. So something to think about is the oil energy story. You know, oil could very soon be closing at $100 a barrel, which hasn't happened since 2013. And the other thing that is also going up is natural gas. So looking at our DFAN play, if you go to the 1 month chart, we see that it's a V-shaped recovery. And if you go to the 6 month chart of DFAN, we see that a triple bottom. So that's very bullish in terms of how these defense stocks could do in face of war. So something to keep in mind as we hopefully, you know, wait for this invasion to happen and the stock market to react.
Yeah, I wanted to point out that if you've been on the channel for a little while, you'll know that one of our plays over here is Gush. And I just want to point out, and I can actually share my screen and show you guys what I'm talking about over here, but this is the double leverage bull for oil and gas. And luckily the past 5 days, it has been up 5%. It does have its better days. I think yesterday it closed at 7%. So of course it must have been down at some point, but year to date it's still up 26%. And right now, if I would be encouraging it, I think that I would personally downgrade it to just a hold versus a buy. But if you really do feel like oil might be increasing more beyond where it is right now, and I think that right now it's trading at $93 a barrel. I know that last week we were speaking like, man, maybe this can actually reach 100. It wasn't as quick, but it is moving up. I mean, every single week when we come back to visit it, it's literally just gone nothing but up. And so if anybody is actually looking into getting into some of this, I use this bar chart website to kind of help me. There's this thing called the trader's cheat sheet. And right now we're looking at Gush. And so what I do, and this is what I do for everything, and I can see where it closed at, which it looks like it's actually a little bit off. If I'm seeing, oh nope, 121.62. So yep, it's accurate. And so what I actually do is on a normal day, if inflation wasn't killing all the stocks and the valuations, or not necessarily the valuation, but the prices, I would be looking at this first support point, which would be 116.29. But since we're in such a volatile market, I've actually been setting my orders right here at the third support point. Of course, I could pull out a chart and do this myself, but I'm a working man, and I want to just take the resources that are out there for me. And so if I was looking to get into this play at all, I'd probably look around this 107.91 time price right here. And that's just my encouragement. Just trying to be careful, like Misael said, $100 a barrel is an 8-year high almost. And so Josh Trusty, if I'm saying this right, I think you were predicting that if they go to war, the barrel of oil might go to $110. And so I just think that it's especially when you're leveraging like we do in this group, I just think you might want to look into some of those indicators there. Anybody else have any thoughts on that?
Yeah, so I mean, I would say Gush is definitely a play that would benefit from a wartime effort with increased usage of oil. One other ETF you might want to consider would be XLE, which is one of the spider ETFs, which is like part of the S&P 500. So they actually have like a Sharpe ratio of 1.91, whereas Gush has a Sharpe ratio of about 1.41. So obviously, in modern portfolio theory, if you want to make more money, you would have to go with like a lower Sharpe ratio, but with like less certainty. So maybe some sort of combination of the two might be something that you would be interested in at some points. But Gush would definitely stand to benefit. XLE, which gives broad exposure to energy in the market, would be also a good option, but that's up about 23%, so less than the 26% of Gush. So yeah, there are definitely a lot of opportunities in the energy space or the oil and gas space that would stand to benefit from a market that is seeing a global war effort happening. So whatever you do, make sure at least you're in the game so that you can actually start making some money here.
Definitely. The only thing that I want to say, just to conclude before we stop today's show, is that if you're actually looking to get into some stocks altogether, I can share with you some of the things that I'm actually looking at, in addition to some of those oil and defense plays. All of these right here are technology. And I think that despite the inflation and the interest rates being like an issue, I still think that as an economy, as a country, they're still going to inherently grow. And I think that the S&P will still close higher than what it opened this year. And so I'm looking for specifically software developers and chip makers. And the one thing that we, of course, need to point out is that Alphabet is doing is 20-for-1 split. And so I'm going to be looking to get into that whenever that is. I need to research what day that actually is, but obviously Google is Google's Google, right? I mean, it's the #1 searching platform of information, and the #2 is actually YouTube, which of course falls underneath Google as well. So they're in a very good spot. And so if you're looking to get in, currently the price is 2,600 right now, but a 20-for-1 split would be somewhere around 134. And of course, I think that would be a very good value play, especially in this volatile market. But with that being said, this is everything that I'm looking into this week.
Yeah. One other note is that one of the advantages of having that sort of like stock split is that you can get more shares and versus say fractional shares, which will enable you to begin like voting even more and have more power and influence within the company. So that stock split will actually benefit the retail investor a whole lot more. So that's just another incentive for you to stay long, stay green. and stay engaged as well.
Hey guys, thanks for checking out the video this week. If you haven't already, please like the video and subscribe to the channel. Every week we're going to be uploading a couple of videos every Saturday of opportunities that you can take advantage of in the markets. Thanks again and have a happy trading week.